Hello everybody, this is David, and I guess this week I'm going to be going over just some basics of investing and the different types, risks involved in it, and kind of the different ways we do it. So first off are the different investment types. There's many different types of investments, but for the competition we're in, the only one we'll be focusing on is stocks. So a stock is a extremely small portion of a company that we're trading on a platform. And there's many different platforms in many different countries that we can trade on and will trade on. But basically, this chunk of the company reflects how the company's doing, if they're growing, making profits, they'll be doing well. If they're not making profits, if they're at losses, their stocks will start dropping. And we try and look for those companies that will be doing better in the future, and we try and buy these stocks for as cheap as we can, and then hopefully sell them once the company's grown and done better to make a profit off of it. So as we look into these stocks, we'll look deeper and deeper into them as these weeks go by, but for now we're just trying to look at general trends we've seen in stocks in the past and trying to see if you can apply that at all to what they might do in the future, and look at very simple things like an earnings report for a company and see how that affects what their stock has done, and see what a good earnings report does to a stock and try and see what a bad earnings report does to a stock. Because earnings reports have a huge impact, or can have a huge impact, on how a stock will do. Now, one thing is, any investment is a risk, especially in the stock market. And that's because a stock is not a guarantee. Any stock you take is a gamble. No matter how much research you do, you won't be certain of what it will do. And they're constantly going to be shifting and changing. But there is a degree to which we can calculate it. So it's not like a complete gamble. You do have some control. But at the same time, it's not always going to be in your control, or not always going to do what it should do. A stock may seem like it should be doing very well and should boom and grow, but it may not. There's so many factors that go into it. There's no tried and tested, proven system to tell you if a stock will do good or not. It's up to research and a little bit of guessing, and just the more time you spend looking at stocks and in the stock market, the more you'll be able to understand how stocks should act one way, but typically do, but there are cases where it won't act how it should, which is why this will always be a gamble. Now, the risk that's involved in stocks are that it's tied to a company. So you're putting money into a small stake in a company. And the problem with that is not all companies are constantly growing or getting bigger or doing better than they were in the past. Some companies will shrink or downsize, which can affect the value because they won't be as big of a power and they won't have the manpower to do what they've done in the past, which will decrease the value of that company, in turn decreasing how well that stock will be valued. And another big impact, like I talked about earlier, are earnings reports. So if a company is expected to do $10 million in sales, for example, and they only make $8 million in sales, they still made money, but it wasn't what people were expecting. And the problem with that is they value the stock at the expect of them to make 10 million. So if they don't make that, the stock was what we call over-evaluated, which means we thought it was worth more than it really is. And if that happens, the stock's price will drop very rapidly. And that kind of leads into a company failing to perform. So if we have set expectations for a company and they fail to meet those expectations, it typically will drop the value of that stock because we anticipated them to be doing better than they actually are. And another thing is, it's difficult to see these coming because you don't know about a company. You don't know what you can't see. So a company may look like it's doing well, but in reality it's not, which is why how the company does is so important, and why learning those earning statements and tracking that and keeping current with news and other things can also help you in the stock market. And the final thing I'll kind of be touching up on this week and try to get you all introduced into is investment diversity. This is a very key component to the stock market because not all parts of the economy will be doing well at once. Some parts may dip, some may rise, and the goal of having a diverse portfolio is to try and counterbalance those dips and rises. So in the stock market, it can be grouped into 11 major groups, but for the competition we're in, there's only 9 of them. And that may seem like a lot, but talking to your team leaders, you're most likely will be assigned to research in depth and understand one of these sectors. And splitting that up and learning about your sector will help you understand better and keep stocks more similar. So you'll be looking for the same things in different companies, which should make it a simpler research time and should make it less chaotic for you to try and research the stocks you're supposed to be researching. Now, the reason we want to be diverse in our portfolio is because it will help avoid large changes at once. Because sectors as a whole can take big drops and hits, and that can happen for a variety of reasons. Say you're doing something in the natural resources category, and some law just gets passed where we're no longer allowed to frack mine for oil or fracture mine at all. That would make a huge impact in that sector and make those companies that focus on that would drop their stocks immensely. So if all you did was invest in natural resources, you take a huge hit and all of your stocks would drop and you'd lose tons of money. But having a diverse portfolio could help prevent that, because if that were to happen, another sector would likely start doing better because of that change and would hopefully help even out the loss and gain, so you don't end up losing a bunch of money due to a change in the near future. And that kind of better prepares your portfolio for any future that could happen with any changes, which is a big part of this competition. Because keep in mind, in this competition, it's not all about making money. It's about building the best portfolio for our client that you can. Now, this is a very good website that kind of shows just some different things and some different stocks and how they've done in the past. And it does a great example of showing some that did very well and some that kind of flunked recently. And it can kind of show just how fast even big brand companies that you might know, how fast their stocks can change, and how big brands that you hear about all the time may not even be doing well. So it's not like just because a company's big, it will always be doing well. Even big companies like Apple, McDonald's, Microsoft can take hits. So make sure your portfolio is well researched. Make sure you learn the sector that you're supposed to be researching, and just know that the stock market isn't really a guarantee in any sense. You can do as much research and you will learn and you'll get better at predicting it, but you won't be perfect. You'll make mistakes, and just keep trying to predict as many as you can. And another thing to note, it is useful to try and find stocks and predict that they won't do well, because then you'll start learning to see markers that will predict that a stock won't be doing well and what to avoid. because learning stocks to avoid is almost as useful as learning the stocks that you want to target. And I think that pretty much wraps up about all I have to say for this week. So just talk to your team leaders and they'll give you further instructions.